Hey, I'm Sal Carola from Remax Elite. I'm sitting with my good friend Joe Percio. Joe is a lender here in Staten Island, and he just recently joined a new company. Joe, introduce the new company that you joined.
Thank you, Sal. Appreciate the opportunity. As you said, my name is Joseph Percio. I am a branch manager with the CMG Home Loans. Just opened a brand new branch here in Staten Island, and it's a company I'm so excited to align with Remax League and just push forward and have an amazing year.
Great, great. Love it. I love to hear that. So the purpose of today's video is to get a perspective view of my industry, real estate, but more from the lending side, which I don't really know that much about. I know a little bit, but so I kind of bring the experts, in to, educate my clients, and then obviously Joe's clients will love to hear his point of view as well. So I have some questions that I'm going to shoot out to him and rapid fire,
All
and
right.
he's going to answer them. Ready, Joe?
Blue.
Okay, first one. From a lender's seat, what are you really seeing right now with buyers? Are they nervous, motivated, or just adjusting?
So I feel like we're coming off the adjustment period. Okay. Right. And I like to say adjusting because we went from, a market where the past few years after COVID, we had high interest rates and everyone's just seeing, oh, they're high, they're too high, I'm scared. And now it's starting to come down, right? So that adjustment period's happening where people are starting to put their toes in the water and say, you know what, is now the time.
Right.
Should I start looking at it? We see good data, rates coming down. So I think we're starting to get more people motivated. There's a lot of content out there, so I feel like there's a lot of misinformation that we as lenders or realtors have to educate to properly inform these people. But I'd like to say we're going from the adjustment period to a motivated period.
Good. I like to hear that. All right. Second question. Rates get all the headlines, but what do you think buyers misunderstand most about today's mortgage market?
So I would say the biggest misconception is exactly that is right. It's when I have a conversation with somebody and their first conversation is, what's your rate? I know that we need to take 5 steps back and we're going to go over what that means, right? The rates are very important. Obviously, rates are very important. It's the rate at which you're paying money back. But what does that mean for you, right? If you go and lease a brand new car, are you asking what their rate is on the lease? No, you're not asking. You're asking what their monthly payment is.
Right.
So I think one of the biggest misconceptions is focusing over here. What you should be focusing over here. Over here's that monthly payment.
Right.
We live in the payment, and you need to know how that interest rate is relative to that payment.
Right.
So just having that information on it, knowing, again, interest rates, the market dictates the interest rates, but you're qualifying for a rate based on your personal scenario.
And it's kind of true that most companies are within very, yeah, I mean, the interest rate is the interest rate. It's really not.
Exactly it. You see average data out there, and it's exactly that. There's data out there that's put out for everybody to absorb, and all the banks are fishing from the same ponds, right? So everyone's gonna be within that 8 to a quarter of a percent of each other.
Right.
You know.
Okay. So, question number 3. Are you seeing any creative strategies buyers are using right now that makes deals work, like buy downs, seller credits, or things like that?
Oh, that's a good question. So I would say now, since we're having a little bit of adjustment, getting a little bit of reduced rates, things are going to change, right? Your creative strategy is always going to change depending where the market is. But previously, when we were sitting at higher interest rates, that buy down was extremely relative,
Right.
right? Because you have somebody who is looking to purchase a house at 500,000, and they may not qualify at the current market rate. And maybe the seller's willing to negotiate with them, reduce their purchase price by 10,000. But I might say, hey, keep the higher purchase price, give them a credit back. Let's use the credit to buy down the interest rate, get them a reduced monthly payment. So that's going to help with their monthly pocket, with their monthly interest, and that's going to help them their affordability.
When you say buy down, we're talking about points, right?
Yes. So you always have the opportunity to purchase upfront interest on an interest rate to reduce your monthly payment. So we always do what's called a break even, like a cost analysis, to see if it makes sense, if and when it makes sense for the client to buy down a point, 2 points, point and a half, whatever fits their scenario. And that has been super important in this past market to get people to qualify.
When would you talk somebody out of buying a point?
When we see a forecast in the market where we think rates are going to start coming down. So right now, where we've been, if somebody says, yeah, I want to buy down, 2 points, 3 points, I always take a step back, try to understand why they want to do that.
Right.
And then I go over the options, right? So if you want to spend 2 points and it's going to save you $150 a month, I'm going to say, okay, these 2 points are costing you X amount of dollars.
Right.
Let's divide it by the 150. You're going to see a break-even point of savings in 48 months.
Okay.
Now I'm going to tell them, hey, you see the trend in the market, right? So if you save a X amount of dollars a month with a 0.5% decrease in interest rate, is that something that makes sense to you? That's something you want to refinance? Yes. Okay, great. If you agree to that, I wouldn't say we're going to lock into this.
Right.
Because then you're going to waste the money that you spent up front.
Good way to look at
So it's always going by their scenario. If they're going to stay in the loan for the whole entirety of the loan, buy down the point.
which usually never happens.
No, I've seen it happen once, and those are my grandparents.
That's that's old school. Look at 30 years in my move. Okay. All right. Question 4. If a buyer came to you today and said, "I'm waiting for rates to drop," what would you honestly tell them right now?
Ooh, so I'm happy you asked that question because we touched on it briefly before. I would say that you have to know what that means, right? So interest rates, which right now are coming down a bit. If we foreseen, well, not even take another step back, right? If you're telling me that you want to wait for them to come down, if they do come down, what typically happens, right? From your perspective as a real estate agent, when you see that the market has lower rates, what happens to house prices?
Well, in a normal market,
In a normal market.
and they go, the
They go-
price is good.
So typically it's like a seesaw.
Right.
One comes down, one goes up. So what I always say is, me personally, I'd rather buy a cheaper house with a higher interest rate,
That's right.
right? So, and the way I look at that is because if I buy a $400,000 house at a 10% interest rate, rates start coming down to 5%. What's that mean? It means two things. That means that somebody can now buy that same property at a 5% rate
Right.
and have more affordability.
Right.
They could buy maybe a $600,000 house to a $400,000, more cheaper rate. Now, on my end, I already own the property, so I can refinance and reduce my rate, reduce my payment.
Right.
If it was the opposite and I buy a higher priced house with a lower price rate, I can refinance my equity.
Right.
I'm stuck at that value that I've already.
The equity's the equity.
Right. That's exactly it.
So, before we go to the next question, I mean, when you say a refi, and a lot of people love to consider refinancing, but it's not always practical when the rates just drop right away. In your opinion, if let's say argument's sake, you lock in at 6, where would you recommend the rates to be before you even start to consider to refi?
Okay.
Does it matter on other things?
So there are different factors, right? So my answer on this is always going to be it depends.
Okay.
Because if you're a 500,000 plus loan and your market interest rates are at least a 0.5% or more better than where you're at, I would say let's get eyes on that mortgage statement.
Okay.
And see if it's beneficial. Let's see what your goal is.
Okay.
How long are you going to stay in the house for? How much savings a month is going to make sense?
That's right.
I've had somebody say, I told them, hey, I could save you $350 a month for you. They said, nope, not enough for me. I want 1,000. Okay. That was saving him 3/4 of a point. That was 0.75% on a $900,000 loan.
All right.
Wasn't good enough for him.
He's got to wait till it drops a little more.
He's got to wait. That's it. He wants to wait. Now, that same scenario, if you have a $100,000 loan and it's a 0.5% difference on your interest rate, it's going to be dollars you're saving monthly. So it's always going to depend on somebody's scenario. And then that's always me analyzing that mortgage statement, giving you a break-even analysis, and then you determining whether or not saving $150 a month is worth it if you can see savings in 25 months.
And plus, there's closing costs involved.
There is. So there's closing costs involved. Good thing about refinances, let's say in New York, for example, we service the majority of our portfolio. So when we refinance somebody that we did a purchase with, we waive any bank fees. There's no application, processing, underwriting. You have mortgage tax that is just about 2% within the boroughs. We'll transfer that to your new loan. So you're going to save 2% right there, right? So you're saving a nice chunk of money. So I would say you want to estimate the loan amount maybe increasing, let's call it $10,000, right?
Okay.
That's going to be the take of a new title. We have a title bill, title insurance policy, and updating your escrow account, taxes, insurance. But those are all things that are relative to the account that you currently have. So I wouldn't say it's necessarily a cost, but you will see an increase in your loan amount, and that always needs to be factored into whether or not it's worth it for you.
So a lot of times buyers ask us, what is my closing cost going to be? And I usually say, well, it depends on what you borrow. And, rule of thumb, I say is usually between 4.5% to 5% of what you borrow. Am I in the ballpark?
That is, so I always go with within the boroughs between 4 to 5%. And I always tell I land about to 4.5.
Okay.
I prepare them for it, but then I always explain, what does this mean? And if I just say it to somebody with no other information, a lot of people get a little turned off because they say, okay, you're just throwing a random percentage at me, but they think that I'm charging them all these different things. So then I break it down and I say, hey, listen, this is what this translates to, right? So 4.9%, you have 2% of it is taxed to New York State.
Can't do nothing about that.
They said, you're in the boroughs, you want a mortgage, you're paying 2%. Nothing I can do about it.
Good old New York.
Good old New York, right? And you have another 1 to 1.5%. It's going to be your title, right? So you have a title bill come in, right? The cost of doing the searches, make sure there's no liens against your property, which is super important.
Right.
A title insurance policy, which is there to protect you. God forbid that there was a lien that popped up on the property that didn't come up during your search. It's going to protect you.
Right.
So that's a few $1,000s at closing, but it's super, super important.
Could be some uncertainty.
It is, yes, absolutely, and that is super important. You'll have the bank itself. Bank will have their application fees. Banks are typically under $2,000 for processing application fees, around $1,500. You have an appraisal fee called direct. It's an appraisal company. Average is around $600. Will increase with multifamily or a higher price point. And then you have an escrow account. So if you want to take an escrow account, which if you put less than 20% down, you have to take one. But an escrow account is there to prepay your property tax and insurance for you, so you're never late.
Right.
So 1% of your closing costs is your money just held to the side in an account.
Right.
You know, and I always reiterate to people, because when they see a fluctuation in closing costs, they say, oh, Joe, why did my closing costs increase by $2,000? And I say, let's pull it up. Let's go over it together. You know, the only other fee that I'm not accounting for that could be there is if your lender charges you that upfront interest that we spoke about,
Right.
and they didn't tell you about it.
Right.
Which a lot of the times what people do is they'll tell you I can get you a cheaper rate, but they don't tell you what goes in to get that cheaper rate
Until later.
until later on.
All right. All right, last question. What separates the buyers who actually get approved and close from those who struggle or just stall out?
Now, I got a question to that so I can answer properly. Now, when you say struggle, are we saying they're struggling to qualify? Like they give you all their information and I receive it, review it?
Yeah.
The struggle is, okay, so
Yes.
the question, so can you repeat it again? I'm sorry.
What's the ones that, actually qualify and close? So those are the good ones. Compared to
The people that qualify easily versus the people that
they're
are
close, yeah, they're those are the easy ones. From the ones that who actually struggle,
well, I mean, so
and then they just stall out.
big difference there is they don't want it enough.
Well, yeah, those right.
Right? I mean, 'cause I have a lot of people that listen. There's a lot of people that struggle. There's a lot of people that we have loan products in place to be able to qualify somebody with a 500 credit score or less money that they're earning, so they need to bump up, max out a DTI or debt to income ratio. But it's all about if that person's got the willpower to do it, right? If somebody actually wants to do it, if they're following up, like I'll give people homework, and say, hey, listen, this is where you're at right now. Here's a credit simulator. You need to do X, Y, and Z to bring you up to this point, so within 3 months, we should be able to get this done for you. I'm like, but you need to do this homework. A lot of times I tell somebody that and nothing happens. They don't want to do it. They don't go through with it, so it's if it's a struggle where it's a struggle to qualify, but they want it versus somebody who just gets it in nice and easy. It all comes down to the want of it, I mean,
And also, sometimes the terms might be a lot worse to somebody who doesn't qualify as well as.
yeah. So and that's what it all comes down to, whether or not it's worth it to you, because listen, it's if somebody has, a 600 credit score versus an 800 credit score, the 600 credit score is going to have a pricier loan because the bank considers it a riskier loan.
Right.
So if it's a riskier loan, they're going to charge higher interest because they don't know if you're in a default or not, right? If we don't have a good history of making on-time payments, they're worried.
Right.
So you're going to pay a higher rate, which, in my opinion, it's completely relevant. It makes sense,
Right.
because they don't know if you're a good borrower or not. Versus somebody who's 800 credit score, have all the documentation, income aligns, and things like that. Listen, they have a lot of power. They have a lot of power because those are the people that just kind of hop around a lot. They go between different agents, different lenders sometimes, and just because they have the freedom to do so. But they prepared themselves for that situation.
So it's not like a carbon copy type of thing.
No, it's not. And I'm not saying that people who struggle aren't preparing themselves. Listen, life just might have dealt them a hard hand.
Oh, absolutely. Everybody could find themselves in different situations at any given point.
Yeah, it's you never know.
Well, listen, this is a great interview, and I love it. But before we wrap it up, I just want to talk about one thing that just recently happened. At the time of this interview, which is January 14th, we had a pretty decent rate drop.
Yes.
Right? We are finally seeing the rates under 6, which we've been seeing for
Yeah.
it's a very And it kind of happened in a way that I have not seen it before. It wasn't because of Fed drop rate or something like that, or 10-year Treasury note. It kind of happened, and I want you to explain it, but it kind of happened through the president, through the White House.
Yes.
You know, he kind of dumped in a few $1 billion into, and I'm going to let you explain to it, but he kind of like,
Yeah, no, he's the catalyst behind it.
okay, so explain what he did, and also it ignited Wall Street.
Yeah.
So what happened?
So any way you slice it, whether or not you like the guy, he's our president and he's a real estate guy. Okay. So I said it from day one. I'm like, he's going to try to revitalize the industry, right? He's going to try to push interest rates down, which he always said he would, right? Any other politics, anything, all that's to the side.
Right, absolutely.
Now, for him making an announcement and saying that they're going to put $200 billion into the market to buy mortgage-backed securities, he's forcing the hand. Right. So now he's actively looking to push that rate down, which he's been trying to do, right? We see a lot in the market and, you know, I was bullying Powell and, you know, all that stuff. So it's creating activity. Now, what I would say that is super, like, to you know, really watch out for, this is great, right? It's great for us. We see rates starting to come down, you know, that fact that we're touching those high fives and, you know, people are in there is just, it's creating activity,
right?
Which is amazing. And it's more people qualifying because of it. Now, what I will say is that he's putting a lot of money behind it, but as much as money as that is, it's going to go quicker than people think, in my opinion, right? Where it's not going to last 2 years. That might last a few months. He might be doing $20 billion a week, you know? So
it can't go on forever like this.
Right. You know, listen, we have a lot forecasted for the year where everyone has their predictions of where we're going to be. You know, hopefully we land those low fives towards the end of the year. You know, a new person comes in at the seat that can help with the rate drops.
It's a gamble, actually. Think about it.
It's all a gamble. And if anybody tells you, hey, I know 100% the answer, and I could tell you for certain that the rate's going to come out of this president, I would say, why are you talking to me? Why are you not retired in Abu Dhabi, sitting on the beach, drinking a gut of coconut? You know, because it's just not possible. We're not. Yeah. But as of right now, that definitely shook up our entire industry. Right. And I'm getting people qualified with cheaper interest rates, qualifying for more money. And if this continues, this is going to be our best year in 4 years.
4 years, right?
Yeah. You know, so it's exciting. It's exciting, and there's uncertainty, but there's hope.
Yeah, I'm gonna say that the next quarter, first and second quarter of this year, is going to be a lot of things are going to be, you know, changing.
We're gonna have a good spring market. Yeah, listen, anything's better, but you know.
But Joe, I love this interview, and I hope we could do more of them. You know, yeah, absolutely, maybe, you know, monthly or quarterly.
Yeah, no, to give people updates, like I said before, there's so much information out there,
right?
And people are sponges, right? People are sitting there on their phones scrolling through help, and you know, you don't know what you don't know,
right?
So if somebody says something to you and says, no problem, I can get you a 4.5% interest rate, no problem, I got you. They don't know if it's true.
Exactly.
And how, you know, who are we to say, oh, you should know better?
Right.
They don't. So all we could do is provide good quality content.
Absolutely.
And educate.
And you know, and again, my view is my clients, you know, they see it from my perspective. No, of course, from the sales perspective.
Right.
They love to see it from your perspective.
Absolutely.
Because, you know, when do they get to hear that? When they're already in the process.
See, that's a very good point. You're right. People aren't taking, you know, there's no real estate mortgage class in the high school that's educating you prior to having to do these things.
Exactly.
You know, it's a crash course while you're in it.
Right. You got to, you know, it's like, I wish I could be educating them as we're showing them homes, or as I'm listing their homes and getting them prepared to move to the next one. And then, you know, but I just don't have that knowledge. But this is a good way that at least they can get prepared for it.
Absolutely. You can bridge the gap.
All right.
Yeah.
Looking forward to the next video.
As am I. Thank you, Sal. Appreciate it.
Well,